This is task 7 of the first sample assessment for personal tax. This task is about capital gains. So in part A, you need to identify whether the following are chargeable to or exempt from capital gains tax. So the first one, we have a gift of an asset with a market value of $15,000 to charity. And the key issue here is that it's to a charity, so gifts to charities are exempt from capital gains tax. Second, we have the destruction of a valuable painting caused by fire. So for this, we need to remind ourselves, well, when do we have a chargeable disposal? So chargeable disposals include when we sell the whole or part of an asset, or if we gift the whole or part of an asset, unless we gift it to a charity, if we receive any money to surrender the rights of an asset, or if we have the loss or destruction of the whole or part of an asset. So in this case, we've got the destruction of a painting, and therefore that is a chargeable disposal. And then for the third one, we've got a chattel with a useful life of 40 years, which is not used for the business. So let's revise what a chattel is. So a chattel is an item of tangible, movable property. Okay, so tangible, movable property. So tangible, so we can hold it and we can move it around. It's not a fixed item like a building, for example. But it does exclude things like shares and leases. Now we've also got the idea of a wasting chattel as well. So a wasting chattel is a chattel where its life will not exceed 50 years. So things like caravans, boats, computers, those are wasting chattels. So in this case, we have a chattel which has a life that is less than 40 years, sorry, less than 50 years. So this is a wasting chattel, and wasting chattels are exempt from capital gains tax. Okay, let's move on to the next part then. So Mr. A sold 4 assets to unconnected persons during the 24-25 tax year. The proceeds and cost of each asset are shown in the table below. So we need to show whether the sale of each asset would result in a taxable gain or an allowable loss, or is exempt from capital gains tax. And the amount of the loss or gain should be entered into the final column. So we've got a desk. So a desk, that's going to be a chattel, but we know that you can get antique desks, so its life may be for more than 50 years. So this is not going to be exempt. So we've got the proceeds there, and we've got the cost. So for us to work this out, we need to have a look at this table, which is a summary of the rules for when we're selling off these relatively small assets. So you see on the top of the table, we've got our proceeds, and then on the left of the table, we've got the cost. So let's look at each of these sort of area by area. So if we start off then, well, what if we have proceeds of more than £6,000? So we make a lot of money on this, and the cost was more than £6,000 in the first place. So this is for big assets, in which case we would treat these assets as normal and work out the capital gains. Now let's look at the opposite side. What if we have a low value item, so we sell it for less than 6,000, and also it costs less than 6,000 in the first place. So the government thinks, well, this is just a small item, and therefore it's going to be exempt from capital gains tax. So the government doesn't want to charge tax on people who may sell a bit of furniture on eBay, let's say. It's not very expensive, so let's not worry about it. So let's look at what if we have a low value item. So we sell it for less than 6,000. Oh, but it cost more than 6,000 in the first place. Well, that seems strange. why would we sell a valuable thing for less than we paid for it? So it could be that this is not really a fair transaction and we're selling it for a low price just to avoid paying any tax. So what the government says here then, well, we're going to ignore that you receive less than 6,000 for it because it doesn't make sense. So we're going to assume that your proceeds are £6,000 and we will work out the capital gains tax based on that level of proceeds. Yeah, you actually receive less than this, but we don't really believe this was a fair transaction. So the person may still make a capital loss on this, but the loss will be restricted because we're going to assume the proceeds were more than they were actually received. And then what if we sell the item for a large amount of money, but it didn't cost us very much? And the situation we have here is, let's suppose you go to a car boot sale and you pick up something for £5, and then when you get it home and clean it up, you discover that actually it's really quite valuable and you sell it for £10,000. So the government doesn't want to punish people who just happen to get a good deal at a car boot sale. So in this case, to help these sorts of people, they are going to restrict the gain. Okay, so remember, if we sell something for 10,000 and we only bought it for £10, that's a lot of tax to pay. Yeah, and that would punish people who find bargains at car boot sales. So we're going to restrict the gain using the formula that you can see there on the screen. So for our desk then, we have proceeds of 7,200 and a cost of 5,800. So with a cost of proceeds of 7,200, so that's going to be in this column, and we've got a cost of 5,800. So that means that we are going to have a gain, but we're going to restrict that gain. Okay. So we've got a gain of 5/3 multiplied by the gross proceeds of the 7,200 less 6,000. So that's 1,200, that's the difference there, which we then multiply by 5 and divide by 3. So that gives us a restricted gain of 2,000. But remember, we're going to restrict the gain to 2,000, but what was the gain in the first place? So we sold it for 7,200 and we bought it for 5,800. So our actual gain was only 1,400. So we don't need to apply the restriction here anyway. So we're just going to use the actual gain of 1,400. So in this case then, that we do have a taxable gain of the 1,400. So the next one we have is a racehorse. Well, that's a wasting chattel, isn't it? So that's a tangible, movable item. It has a life of less than 50 years, so that would be exempt. And remember, the question said we should enter a 0 in our answer if we pay no tax. And then what about the mirror? So again, a mirror is a chattel, but yeah, we could have an antique mirror, couldn't we? So it might have a life of more than 50 years. So let's have a look at our table for that again now. So we've got proceeds of 5,500 and a cost of 6,300. So our proceeds are 5,500. So we have a small amount of proceeds, and then the cost was 6,300. So this is an example there where we bought something for quite a bit of money, but we've sold it for less. So the government thinks that possibly we're trying to avoid paying tax. They say, well, I don't really care that you only receive 5,500. We're going to assume that you receive 6,000. So in this case, if we assume we receive 6,000, that means that our gain is just the difference of 300. Although not a gain in this case, though. We had a cost of 6,300, so we'd have an allowable loss, wouldn't we? So yeah, we'd have a loss of 300 in this case. Yeah, so we'd have a cost of 6,300 and we're going to assume that the proceeds were 6,000. And then we have a car, and we just need to remember that cars are exempt. Again, we could recognize that, again, the car is a wasting chattel, isn't it? So it's tangible, it's movable, and in most cases likely to have a life of less than 50 years. So we know there are some cars that have a longer life than that, but in this case, we're going to say that it's exempt. Yeah, so there'll be no loss there. So you just need to remember cars are exempt. Okay, the last little bit of the task then. Mrs. B bought 30 acres of land for 126,000 in December 2000. In April 2024, she sold 10 acres of the land for 75,000. The remaining acres were valued at 175,000 at the time of the disposal. Okay, so for this then, we need to split the land because we bought 30 acres and sold 10 of them. So again, let's have a look at a diagram to help us understand what's going on here. So we've got this piece of land, and remember there's 30 acres in total, but we've sold 10 acres of it. So 10 acres have sold, we still have 20 acres left. So we are selling a third of the land. But when we're working out our tax, we don't care about the proportion of the land. We need to work it out in terms of the value of the land. So we're told that originally we bought the land for the 126,000. So that's the figure we have on the left. And then we sold the 10 acres for 75, and the rest of it is valued at 175. So we sold the 10 for 75, the remaining is worth 175. So the combination of both of these is 250. So what we're going to do then, we've got our original cost of the 126,000. So we're not going to split that 1/3, 2/3 in terms of the number of acres. We're going to split that in terms of the values. So we want to work out there what is the value of the bit of land that we've sold in terms of the original cost. So we're going to multiply by the 75,000 we've sold it for by the value of the whole land at the moment. That's the 250. So our 126,000 times by 75 divided by 250. So that gives us that our cost for the capital gains purposes is going to be 37,800. So but the cost of the whole lot was 126,000, and then 75 250ths of that is 37,800. So we can complete the table now. So the proceeds, well, we sold this 10 acres for 75,000. And then we're going to value it at 37,800. Now this is a cost, isn't it? Should we put a negative number in here? Well, it tells us do not use brackets or minus signs. So the computer-based exam software is expecting us to put a positive number in here. And so that's our cost, the proportion of the original cost. And then that gives us a gain of 37,200, the difference between the two.